you for tuning in. Our next presenter is Dan Matlow, CEO of VitalHub. Mr. Matlow, you may begin.
Thank you, everybody. It's Dan Matlow here, President and CEO of VitalHub, and I'm joined by Brian Goffenberg, our CFO of VitalHub, and thank you very much for attending our first presentation of 2021. So we're excited to get into a new year here to present VitalHub to those investors. Feel free. I think there's a Q&A thing for anyone that does have questions, and we'll be happy to entertain those as we go through there. Just a little bit of my background before we get started. I'm the President CEO. I've got 30 plus years in the software industry, 25 of those in the healthcare IT software-based space with numerous ventures. We've been working with publicly traded companies in the healthcare space since 2008, so we're going on 12, 13 years on the public markets with a predecessor company called MedWorks, which was sold off to private equity in 2016. Brian joins me, and he was the CFO at MedWorks as well prior to this. So we do have some good experience with that, and we're excited of what we've accomplished so far at VitalHub, and would like to talk to you about what that's all about. The company, I'm on slide 3 here now, is focused in the healthcare IT software space. So we are 100% technology-based, software-based organizations. We are not focused on buying clinics, and we don't own any brick and mortar, and we don't own any other clinical-based organizations to do that. We're focused on 2 areas, or strong organic growth and strong M&A. So we've completed 8 transactions so far in the software-based organizations, and we've seen some large organic growth. So both of those are important to us in terms of our metrics. We're a very fundamentally based driven company, very numbers driven, and very focused on our based software. We focused on large healthcare organizations, so we're not into selling individual general practices of physicians and so forth. We like government-funded based organizations, and most of our organizations are government-funded based, being it hospitals or community agencies that we focus on to do that. So let me talk a little bit about, try and move the slides forward. Our company is focused on, as I said, M&A and organic growth. We're sitting in a very strong financial position, so we've been EBITDA positive for a while now in terms of adjusted, and we've seen strong growing of our annual contract value, where 70% of our recurring revenue is recurring in nature. Our customer base is very focused in terms of long-term qualities and community agencies in the mental health space. Our SaaS space runs at high margins, and we have a strong management board with proven successes. So we've been targeting acquisitions with organic growth. We focused in 2 areas, which we call the patient flow and the community agency space, as I mentioned forth, and I'll tell you through what those solutions are in a little while. With the patient flow visibility area, where we're seeing a fair amount of our organic growth. We have our own offshore development group in Colombo, Sri Lanka, which is a big part of our cost saving-based strategy. So we have a strong R&D strategy, which moves our costs over to there. We're internationally based. Our solutions are based in the U.S. We have a little bit. Canada and the U.K. as being our primary markets, but we do have implementations in Australia, Qatar, in the European markets, and Latvia as well. So we truly are an international-based organization, and we believe in order to scale, we need to be an international-based organization. So we're not just Canada-specific, and it's a very key component of what our strategy is so far in terms of what we offer. Besides myself and Brian, our management team is headed off by a gentleman, Vijay Kumara, 30-plus years of heading off our development in the healthcare IT space, and Robert Lazar, who's got 30-plus years almost as well, with professional services, all in the healthcare IT space with large implementation abilities to do that. Vijay also heads up our Colombo, Sri Lanka-based group, although he's based in Canada. He is the individual who set up that offshore development group going back about 10 years now, and very strong in that area. Neil Topping heads up our EVP of our business development group, again, with 20-plus years of experience in those particular areas as well. Our board is myself and a gentleman named Francis Shen. Some of you might know Francis from Astra Technologies, which is a very big growth. He's also a very strategic investment. He heads up our M&A group, but Astra grew to a very large scale, was sold off to Mitel a long time ago, but did very well for investors. And it primarily grew through M&A as well, so he has a lot of experience. Krishnar, who has former audit chair of Canopy Growth, has been on the public markets for a long time, being helped with the public markets. Many may know Roger Dent, heads up a fund called Quinsam Opportunities, but he was a former portfolio of Matrix. He's a former Yorkshire Securities startup as well. Barry Chisholm heads up our Ernst & Young, who heads up our audit committee chair. He currently serves as the audit chair at Noranda. And a gentleman by the name of Stephen Garrington, who's based out of Europe and Australia, who heads up our international-based, a lot of our international-based, public at three other organizations that are publicly traded, but very much highly experienced in the international healthcare-based market. A little bit on where we've come to today. So the market size opportunity, I think, is big in healthcare IT. We all see what's going on with healthcare IT based software-based experience, but we think the areas that we do is about a $1.5 billion marketplace when we look at the amount of beds. We price most of our solutions on base of how many hospital beds are allocated to those particular organizations. Using an average price of $500 per bed per solution, we get to about a $1.5 billion marketplace at a 3 million bed target market. When you look at those countries in Canada, Europe, in the Mideast and Australia that we particularly are going after for both M&A and organic growth. So the company started in 2016 as VitalHub, which had a mobile-based solution as a private-based company. It went public in 2016, and immediately we did acquisitions in the community mental health space of a company called B-Sharp. And that's where we got our offshore development-based group in Colombo, Sri Lanka, which did a fair amount of their development group. It's a 100% owned group, as I said. We then acquired, which is our go-to-market product in the community mental health space, with a product called Treat, with a company called Hynex in 2017 area, and then two small other companies called Roxy and Clarity. And those four companies would drive our community mental health-based organization. The Treat product is our primary product, the full-blown electronic health record-based system. It is the leading product, as I said, with a large install base in the Ontario marketplace in Eastern Canada, and going through with sporadic implementations in the Western Canada as well. And we do have a large contingent of solutions in upstate New York as well. In the end of 2018, we closed a large transaction that went into 19 with the province of Nova Scotia that will ramp up to $20 million in revenue over a 10-year period. We expect that product to grow, that account to grow to $2.5 million in annual recurring revenue, which we're only recognizing about $300,000 of the 2.5 now, but we do expect it through 2021 to get them live on numerous systems. We've been building out systems for them through into 2019 and 20, and we are going live with some systems through 2021. So we do expect that to grow to that. The company itself right now is doing about over $14 million in recurring revenue that we have to date of our 21 million revenue stream that we do. And so the 2 million will be a significant increase to the 14 million plus that we're doing in recurring revenue right now. So it is a very important solution for us. In 2019, we entered the patient flow visibility market, which is that market which looks at how patients are moving through healthcare organizations through analytics and other solutions that there, and I'll describe those solutions in a little bit. We acquired a company called Oak Group, which is about a $1 million plus based business that has clinical analytics that would determine the appropriateness of a patient in a healthcare setting and determine if they should or shouldn't stay in that system. Oculus is a Canadian company based out of Waterloo, which we acquired at the end of 19. It's over a $2 million base revenue-based company that's installed in about 25 different hospitals across Ontario and Manitoba right now, and provides real-time predictive analysis and analytics that provide from the emergency department to operating room performance to utilization of patients throughout hospital settings. And we are looking at expanding that into the international marketplace and have opportunities that have arisen in there. In Q3 of 2020, we've introduced two really nice offerings with a company called InTouch in transforming solutions. In pounds, we acquired about over close to $5.5 million in pounds, so close to $8 million in revenue between these two base organizations. Both of these companies are growing very nice organically, and we think we added significant revenue from these both organizations in Q4 of 2020. So we're looking forward to getting those numbers out to show what that has to offer in the near future. But both of those are there. So InTouch has patient flow systems that patients use. So if you think of kiosks within a hospital or mobile apps that allow you to pre-register before you come into a hospital-based setting, or we can communicate with you. So they're patient-focused, where patients actually use those systems. Where transforming gives you data on how hospitals or regions of hospitals or regions within a regional setting, being community care, long-term care, and hospitals, are doing as an integrated healthcare network. So transforming is focused on those base systems. Again, both of these have seen significant growth during the COVID-19 pandemic, as both of them are very much involved with virtual care, as well as providing analytics in terms of dealing with the COVID-19 response in hospitals. And you can imagine in the UK with what's going on there, how these solutions are being used. So we like these two solutions very much as part of our organic growth. Again, in the mental health area, we have full-blown electronic health records in the community agencies that would compose the complete ERP system of healthcare organizations, from registrations to documentation of the patients to billing systems to patient portals through to virtual care-based solutions. And we got about 150 customers that are using all those four different companies, with the Hynex Treat product as being the center, and that's also the solution we're used in the Nova Scotia-based deal that we were talking about, that large base organization. But Treat is definitely growing very nicely in there. The patient flow visibility would be the MCAP, the Oculus, and now the InTouch based solution. But InTouch is the movement of patients amongst different healthcare facilities in monitoring those activity and helping those patients move effectively through those basic particular areas, as well as giving analytics to the hospitals on how the patients are doing. So if you can think of capacity issues within hospitals, capacity is a huge issue with COVID-19. These solutions are used pretty extensively through all of our particular customers, as well as they've been selling particularly to those particular customers. Some of the solutions that we offer are MCAP, which is giving you analytics on the appropriateness using clinical things, a lot of dashboards and opportunity things, StayTrack, which are those boards that you would see as you go into hospitals, that they would have in individual patient rooms or on wards. Predict, which is predicting emergency capacity, as well as giving patients how those emergency rooms are doing. The Shrewd systems would be COVID-19 responses in terms of how the hospitals are filled up, giving you things such as PPE, as well as COVID ventilator capacity on COVID-19. We have a product called Synopsis, which is elective surgery based, which allows you to give a virtual care assessment before you come in for elective surgery, so you don't have to go into a hospital, only to name a few. But we have a full suite of products in those particular both domains that would do that, visibility-based solutions that would work right across those particular areas. Our M&A strategy is again a key component of what we did. And as I said, we've done 8 different acquisitions, and we're expecting to do a fair bit more. Big motives are we reduce our R&D spend through our offshore development-based group based in Colombo, Sri Lanka. So we think in all of our acquisitions we can produce R&D in a pretty extensive way, and we have done that. We're going to consolidate G&A, we cross-sell our products, and we optimize our sales and marketing, and we sell organically through there. So we do have a strategy to grow through that particular group, and we're looking at that as a particular big component of what we have to offer. We have about 400 based organizations to do that. We're sitting on lots of different NDAs right now, and we expect to do some M&A going into the relatively near future as we get some of these done to do that. We're targeting companies between 1 and 12 million. We've been using a combination of stock and cash, although some of our acquisitions have been all cash, and we're moving into those directions. We're looking at reducing costs between 20% on our acquisitions. And as a company, I hope that's all we're looking to get to 20 to 30% EBITDA. And we're starting to approach those particular metrics, I think, with our latest acquisitions, being that we're a 20 million North-based company. We've been buying companies between 1 and 2.5 times revenue as a particular multiple, as a percentage of revenue right now. Companies tend to be break-even or profitable-based businesses when we go after them to do that, and we make sure that's a big part of what our criteria is in terms of what we like to do. What are we looking for? We're looking for recurring revenue above 60%. The company as overall is approaching 70% of our total revenue recurring in nature. Break even or profitable. They tend to be owner-operated businesses that are looking for exits or to become part of a larger-based organization. A large component of our expense reduction is in the R&D component through our M&A, through our Sri Lankan base too. They tend to have little commercialization and limited expansion beyond their boundaries, but we're looking at doing a better job of commercializing them on a go-forward basis. I'll turn things over to Brian Goffenberg just to talk through some of our financials.
So our revenues, we look at a number of metrics, key metrics, when we're looking at revenues. One is organic, the amount of organic revenue that we achieve each quarter, and that we measure that by taking the purchased revenue for if we bought a company for $1 million and we sold, we did $1.2 million in that quarter, we would have had, say, 20% of that would be organic growth. So you know, we pride ourselves on being both growing through organically plus through M&A. So you can see over the last number of quarters, even though the percentage has gone down, the actual dollar amount has been relatively stable and probably will, and we'll start seeing that probably go up as we continue. The other metric we look at is recurring revenues. For us, it's we de-risk the business by growing our ACV base, and you can see the recurring revenues have consistently gone up quarter over quarter, and we'll continue to see that grow, as we go forward. Dan, next.
Yeah.
Historically, our financial performance, we look at our adjusted EBITDA as our primary driving metrics. Why? Primarily because we have two major numbers that flow through our income statement. One is our people cost, and the second one is amortization. Because we're doing a lot of M&A, we end up writing up the intangible assets and then amortizing them over a period of time, anything from 5 to 12 years, depending on the asset that we acquire. And so you'll see there's a huge amount of amortization that flows through our income statement. So we'll be adjusted EBITDA positive way before we have a net income. But our adjusted EBITDA, other than the one-time charges for acquisitions, pretty much mirrors our cash flow position. So we typically generating cash from operations, and we have been doing so for the last number of quarters. Our annual contract value to us is a huge metric, de-risk the business significantly. We've grown that quarter over quarter, and we'll do that both through our M&A and through organic growth. We're at about, we ended Q3 at about 13.5 million, and we've grown significantly this last quarter. So we should go into the new year north of 14.5 million. Dan?
I'm trying. There you go.
So as you can see, our ACV quarter over quarter, we've grown that pretty nicely, and to end up at the end of Q3 at 13.5, and we're north of that now, as I said, probably going into the year with closer to 14.5 million of ACV. Our cap table, we've got about 35 million shares outstanding at 290. I think we closed something close to it today. It gives us a market cap of about 101 million. We've got about $24 million of cash on hand, no debt, and so we give us a market cap of net market cap of 77.5 million. If we got a run rate of 22 million, gives us we're trading at about 3.5 times revenue, which we think is pretty modest. A lot of the comps in the same space in Canada are trading at about 9 times revenue, and in the States they're trading at probably on average about 19 times revenue. We think that we're pretty modest price, and we think there's a lot of room for upside. Just some deals that we did this year. We closed a $15.3 million board deal in March, primarily institution-based, and we closed another deal in November with $17 million. Also, a lot of institutions and some retail. Both board deals which closed in. And the first one was done at $1.80, and the second one was done at $2.90. Just some comps. If you can look at, you can just see the USA and the Canadian comps. As I say, we think we're pretty modestly priced compared to some of our other comps. We're pure SaaS based. We're a software company with high margin revenues, and we're cash flow positive from operations. So the cash that we've taken in will be used for M&A to grow our business.
Just, as I said before, we have this large deal with province of Nova Scotia, even though our annual recurring revenue is well above 14 million, and we think we're growing between 500,000 to $1 million per quarter organically. That doesn't, we do have this large wild card in the play with Nova Scotia, which we expect to grow by about a couple million over the next 2 years, just from recurring revenue in its own in terms of a contract. So we're in the process of rolling that out right now. And as I said before, we have our own offshore development group in Colombo, Sri Lanka. It's been in business with about 44 developers, which is a big part of what we have, of what we do in the marketplace to do it. I think that's about it in terms of that. I don't just see if there's any Q&A at all.
There are some questions. I'm not sure how we access them. Oh, there we go. Q&A.
Yeah, I got.
Okay.
We have a question.
The first question, Bobby. The first question is, what are the 1 or 2 things investors should look for in 2020?
2021.
2021, sorry.
I'll take a shot at that. I think the 2 things that we should look at is, I think the market to date has perceived us as M&A, and I think we are really good at M&A, and we're going to do some acquisitions. So you should look at the acquisitions that we are going to make, and in terms of what there is, I think we're pretty good shoppers for that. The second thing, which I don't think they think we're getting our reputation based on, is organic growth. So we're seeing organizations that are not growing organically at the rate that we're growing with much higher multiples than we are, but we are adding significant deals on a quarter, and we're announcing those deals, and we're excited when those get into the marketplace. So we are getting SaaS deals. COVID has been, in the UK for a lot of our stuff, has actually been pretty good for us so far in terms of what it is, and we expect that to continue to do that on a go-forward basis. So those are the 2 things that we'd like people to look at.
Next question, Dan. On an earlier slide, you mentioned an average revenue of $500 per bed. Is that for all services included in each bed, or just VitalHub services? I believe you mentioned you had 50,000 beds installed.
The marketplace is 50,000. Yeah. I don't think we have 50,000. Yeah. Our average price, if we sold everything, would be $500 per bed for all of our stuff in terms of that market. But we do have 50,000. Not all of them are getting $500 per bed, but we do have the ability to upsize for those. So that is an element of what we have.
Next question. Do you plan to list in the U.S. that'll give a higher valuation?
We are looking at, we have started to explore some of that U.S. stuff. I think we would list up on the TSX before we would start going into the U.S.-based marketplace to do that. We have started to explore that. It may give us a higher valuation in listing in the U.S., but I think the first one would be a an upsizing from the venture exchange to the TSX-based market. So we are looking at both of those avenues into the future.
That's all the questions. Any other questions?
I don't think they can go through. I'm just going to refresh it here. Okay. Thank you, everyone. My email is dan.matlow@vitalhub.com. If anyone has any questions, there might be some people online that we've spoken to in the past or not. But if you do want to get more information or have us present to a group that is of interest to you, feel free to reach out and we'd be happy to do that. Again, thank you, everybody.
And that concludes today's webcast. Thank you very much.